While modern portfolio theory suggests that simply bundling volatile, uncorrelated assets will naturally optimize your efficient frontier, this academic ideal frequently disintegrates when removed from the sterile environment of a textbook. In the real world, diversification by ticker count offers a false sense of security. During systemic liquidity crises, disparate assets often move in lockstep, rendering naive diversification useless. Our strategic objective of our architecture is to move beyond this, toward a system of structural non-correlation. We have engineered this portfolio to function like a mechanical safety valve, a pressurized engine built for long-term capital expansion secured by defensive anchors that only operationalize during periods of extreme market duress, such as inflationary shocks or stagflation. This structure is designed for resilience across the entire market cycle, intentionally sacrificing the final frenzied peaks of speculative mania to guarantee survival through the devastating, wealth-destroying valleys of systemic collapse. The primary turbine of this architecture is the growth engine, consisting of a globally diversified equity sleeve. While equities are an essential long-term pass-through for inflation, we treat them as a highly volatile fuel source subject to a phenomenon known as volatility drag. To understand this, look at the first equation. RG is approximately U minus sigma squared over 2. In this context, RG represents the geometric rate of return. This is the actual realized wealth that hits your balance sheet. The variable U is the simple arithmetic rate of return, while sigma represents annualized volatility. This relationship demonstrates that volatility is not just a subjective measure of risk or a psychological hurdle. It is a tangible mathematical friction. Consider a practical example. If an equity engine generates a 10% arithmetic return with a 20% volatility, the term sigma squared over 2, which equals 0.02 or 2%, acts as a tax on your growth, reducing your actual compounding rate to 8%. To mitigate this, we do not simply buy the broad market. Instead, the growth engine is systematically tilted toward high-quality, cash flow generative factors. This rigorous filtering process dampens the internal volatility, or sigma, of the equity sleeve. By lowering the volatility, we reduce the quadratic drag, ensuring that more of the engine's raw power is converted into realized compound wealth rather than evaporating as market friction. By mastering these structural mechanics, we configure the growth engine to maximize long-term returns through stability and mathematical efficiency rather than raw, unbridled volatility. To build a truly resilient portfolio, we must recognize that defensive architecture cannot rely on assets that share the same underlying economic risk factors as the growth engine. If your hedges respond to the same stimuli as your equities, such as interest rate hikes or liquidity contractions, they will fail you exactly when they're needed most. This system replaces traditional, fragile diversification with a three-pronged mechanical shock absorber designed to withstand diverse macroeconomic stresses. First, we utilize short-term treasury bills. These function as dry powder, providing immediate, liquid ammunition with virtually zero duration risk, meaning their price remains stable even if interest rates spike and crush long-term bond values. Second, we integrate physical gold. As a historical, finite, undebasable asset, gold serves as a hedge against the erosion of fiat currency. It is particularly potent during regime shifts where trust in central bank policy falters or when real interest rates, the nominal yield minus inflation, turn negative. The third and most critical component, the mechanical crown jewel, is systematic trend-following managed futures. Unlike passive assets that simply buy and hold, these are algorithmic strategies that exploit market directionality. During extended bear markets, these algorithms identify and exploit downward momentum by shorting equity, bond, or commodity indices. They act as a capital waterfall, capturing the liquidity fleeing the equity engine and holding it safely in cash or short positions until the turbine is ready for re-engagement. The necessity of these specific counter-cyclical anchors is highlighted by the inherent instability of asset correlations. To understand this mathematically, consider this second equation. Rho xy equals covariance of x and y divided by the product of standard deviations of x and y. This formula defines the correlation coefficient, represented by the Greek letter rho, between two assets, x and y. It is calculated by dividing the covariance of the two assets, the measure of how much they move in tandem, by the product of their individual standard deviations, or volatilities. While rho may drift near zero during calm, trending markets, it is a dynamic variable, not a static constant. During systemic liquidity crises, such as the 2008 financial collapse or the 2020 pandemic panic, the correlations of all risk-on assets rapidly converge toward 1.0. This phenomenon occurs because leveraged participants, facing margin calls, are forced to sell whatever assets they can regardless of fundamental value, triggering a localized cascade of liquidations. We witnessed a critical structural breakdown of the traditional model in 2022. For decades, investors relied on the negative correlation between equities and long-duration bonds to provide safety. However, as inflation spiked, that relationship flipped to a positive correlation of approximately 0.6. This meant that the 60-40 portfolio failed as a safe haven precisely when it was needed most, as both halves of the portfolio plummeted simultaneously. By recognizing that correlation is a dynamic vulnerability rather than a fixed safety net, this architecture replaces the hope of passive diversification with the mechanical certainty of trend following and non-debasable assets. This ensures the portfolio remains resilient even when traditional fixed income hedges fail during complex inflation-driven shocks. Every architecture has its specific vulnerabilities, and this design is no exception. Its primary weaknesses are prolonged low volatility inflation, where trends are too weak to capture, and rapid V-shaped market reversals. In a sharp V recovery, trend-following models can be whipsawed, meaning they transition to defensive short positions just as the market hits its bottom and begins a violent move upward. While these moments can be frustrating, the strategic focus remains on avoiding the terminal compounding spiral caused by deep, catastrophic drawdowns. The third equation, G equals D divided by 1 minus D, illustrates this mathematical reality. Here, G represents the recovery gain required to repair a drawdown of D. This relationship is aggressively nonlinear. While a 10% drawdown only requires an 11% gain to recover, a 50% loss requires a 100% gain just to break even, and a 90% loss requires a 900% return. By keeping our defensive anchors structurally non-correlated, this system aims to limit systemic drawdowns to approximately 15%. This keeps the recovery hurdle at a manageable 17.6%, ensuring that the engine of compounding is never permanently stalled and that long-term wealth is protected from the math of loss. To eliminate the psychological self-sabotage that often occurs during market volatility, we implement strict, threshold-based rebalancing. Referring to the fourth image, you will see a plus or minus 5% band, which represents the allowable deviation around our core asset allocations. For example, if a target allocation of 40% in equities drifts beyond 45% during a bull market or falls below 35% during a correction, the rebalancing algorithm triggers. This mechanically forces the investor to harvest profits from outperforming assets and channel that capital into underperforming ones. This is the disciplined operationalization of buying low and selling high, bypassing the cognitive biases of fear and greed that lead many professionals to buy at the top and sell at the bottom. Furthermore, the architecture maximizes returns through a rigorous asset location protocol. We recognize that taxes are a significant drag on the geometric rate of return. Consequently, tax-inefficient, high-turnover assets such as managed futures that generate frequent short-term gains are located in tax-advantaged accounts like IRAs or 401ks. In contrast, tax-efficient, low-turnover equity ETFs are held in taxable brokerage accounts to take advantage of long-term capital gains rates and dividend efficiencies. This maximizes the net of tax yield and prevents fiscal leakage from devouring your compound growth over decades. The ultimate trade-off of this disciplined approach is the certainty of underperforming during a rampant speculative bull market. It may feel like driving a high-performance car with the parking brake partially engaged while others appear to be gaining ground.
However, this drag is the necessary insurance premium required for an unsinkable financial ship. This architecture is built for those who value structural logic over financial hype, prioritizing the objective certainty of surviving systemic collapses over the temporary psychological high of capturing speculative peaks.